Right now, if you turn on any financial channel or scroll through any investing forum, you will hear the exact same story repeated on a loop. The story goes like this. Nvidia's golden era of parabolic, jaw-dropping hypergrowth is finally exhausted. They'll tell you it's become a bloated, maturing giant, that all the easy money has already been made, and that the smart investors are quietly rotating their capital out and into the next shiny new toy in the artificial intelligence supply chain. But what if I told you that story is dead wrong? What if the single most important company of the entire AI revolution, the undisputed poster child of this new era, is right now trading at a valuation multiple that is actually cheaper than slow-growth, boring legacy retailers like Walmart? It sounds completely impossible for a company growing this fast, and that is exactly the myth versus reality disconnect we are dissecting today, because the market may be betting confidently on entirely the wrong outcome. Before we dive into the data, if you find this kind of contrarian, no-hype breakdown valuable, do me a quick favor and hit that like and subscribe button. It genuinely helps more than you know. Now, let's get into it. Take a good look at this divergence, because it is genuinely one of the strangest things I've seen in the market recently. For most of the year, Nvidia has essentially been what traders call dead money. While the broader semiconductor index surged anywhere from 58 to 75%, Nvidia experienced a staggering $1 trillion wipeout in market capitalization from its all-time peak. The stock itself has only crawled up somewhere between 5 and 13% year to date. Now here's the part that should make you sit up straight. Over that exact same period, while the stock was going nowhere, the actual underlying business grew its revenue by an incredible 85% year over year. Let that sink in for a moment. The stock price went sideways and even down, while the actual engine of the business exploded upward. So what on earth is making the market so absolutely terrified of a company that is fundamentally printing money at this scale? There are three main fears driving this brutal squeeze on Nvidia's valuation. The first is what we call the hyperscaler threat. Investors are genuinely terrified that giants like Meta, Google, and Amazon are aggressively pivoting toward building their own custom, in-house chips in order to break free from their reliance on Nvidia. The second fear is the so-called CapEx cliff. This is the belief that the moment this initial wave of AI spending cools off, Nvidia's revenue will fall off a cliff and crash. And the third fear is a rotation into memory chips, with capital flooding into companies like Micron and SK Hynix, because a growing chorus of people now believe high bandwidth memory is the real bottleneck in the AI race. I'll be honest with you. On the surface, this is a genuinely compelling bear case. It sounds smart, it sounds cautious, and it sounds like exactly the kind of thing a seasoned investor should worry about. But here is precisely where this story starts to get far more complicated and far more interesting than the headlines want you to believe. Let's start with that first fear, the idea that custom in-house silicon is quietly cannibalizing Nvidia's dominance. The problem is, that fear just does not align with the actual data. In the most recent quarter, Nvidia's share of the AI inference chip market didn't shrink at all. It actually increased by 8 full percentage points year over year, climbing to a commanding 74%. Their inference revenue alone is outpacing key competitors like AMD and Broadcom combined. So the market is currently pricing in a massive, catastrophic loss of market share that, quite simply, is not happening in reality. But this raises an obvious and burning question. Why aren't the biggest, richest tech giants on the entire planet just building their own cheaper chips and cutting Nvidia out of the equation entirely? They have the money, they have the engineers. So why don't they just do it? The answer comes down to a concept called the total cost per token. You see, when these massive customers sit down to evaluate their real compute costs, they are not just looking at the raw hardware price of the chip, which, funny enough, is basically the only metric that custom chips actually manage to compete on. Instead, these giants are looking at the entire workflow economics from top to bottom. Nvidia's exceptionally sticky CUDA software ecosystem, their advanced networking capabilities, and their absolutely relentless rapid iteration cycles all combine to give them a comprehensive, unbroken economic edge over any in-house alternative. In other words, the chip is only a fraction of the real story. And this unbroken competitive moat translates directly into numbers that, frankly, make the entire bearish narrative look almost irrational. In the first quarter of fiscal year 2027 alone, Nvidia generated $81.6 billion in revenue. But here's the number that truly matters. From that revenue, it generated a staggering $48.6 billion in free cash flow. Just pause and think about the sheer scale of that cash generation for a single quarter. The entire narrative of a slowing, tired Nvidia is clashing violently against the reality of a fundamentally unparalleled financial engine. And this brings us to the single metric that investors actually care about the most. And it is exactly where the biggest anomaly in this whole story is hiding. Because the stock has traded sideways while earnings have absolutely exploded, something fascinating has happened to Nvidia's valuation. It has aggressively compressed. The stock is currently trading at a forward price to earnings ratio of roughly 18 to 23 times earnings. Now let me put that into real perspective for you because it's almost hard to believe. That valuation is basically in line with the broader S&P 500 average. It is actually cheaper than Nvidia was valued before the AI boom even began back in 2019. And, most incredibly of all, it is now priced cheaper than boring, slow-moving legacy retailers. The fastest-growing critical company of the decade is priced like it barely grows at all. But before you get too excited and too bullish, we have to be intellectually honest and pause to ask ourselves one genuinely hard question. Could this actually be a value trap? After all, the market narrative firmly insists that custom chips will eventually kill demand, that the stock carries heavy downside risk, and that hypergrowth is truly exhausted. And yet, the fundamental reality shows us the complete opposite. Growing inference market share, an average market valuation multiple, and cash flow generation that is virtually unmatched anywhere in the world. The gap between the popular myth and the data-driven reality has rarely, if ever, been this wide. And yet, even if you fully accept all of these incredible fundamentals, there's a massive catalyst brewing right now that almost everyone in the market seems to be completely ignoring. Here it is. Everyone is hyper-focused on GPUs, the graphics chips that made Nvidia famous. But behind the scenes, Nvidia is quietly and aggressively pushing into the central processing unit, or CPU space. Their brand new Vera CPU is specifically targeting agentic AI workloads. And in doing so, it opens up a completely new $200 billion total addressable market. Management already anticipates roughly $20 billion in CPU revenue this year alone. That is a colossal growth opportunity that is being almost entirely overlooked by the current gloomy market narrative. Now, even with a brand new $20 billion revenue stream opening up, we all know that in a volatile market, investors crave a safety net. So what happens when a company like this decides to build one of the biggest safety nets in market history? Well, think about it logically. What do you do when you are sitting on nearly $50 billion in free cash flow every quarter, and you firmly believe your own stock is undervalued? The answer is simple. You buy it back. Nvidia is right now actively executing an $80 billion share buyback program. This is not just a small token gesture to keep shareholders happy. This is a historic return of capital that effectively places a firm, structural floor underneath the stock, protecting it against further market volatility. And interestingly, this exact safety net is causing a dramatic and fascinating split in how different types of investors are behaving behind the curtain. On one side, retail sentiment has noticeably cooled off. On the popular platforms that track everyday traders, sentiment has quietly dipped from extremely bullish all the way down to merely neutral. Everyday traders are showing very clear signs of fatigue, endlessly waiting for a breakout that just hasn't arrived yet. But on the other side, the institutions are behaving completely differently. Hedge funds have aggressively bought this exact dip, pushing their semiconductor exposure to roughly 10% of their total portfolios, which represents the fastest buying pace we have seen in years. Read that again slowly. The so-called smart money is quietly and patiently accumulating shares, right while ordinary retail traders are getting bored and walking away. And for those retail traders who are sticking around, desperately hoping that some sudden, explosive event will swoop in and save them, I'm afraid I have some genuinely bad news. If you are sitting there waiting for a massive, meme stock-style short squeeze to ignite the next rocket rally, the hard data simply is not there to support you. The total short interest sits at roughly 310 million shares. That may sound like a lot, but it is a truly minuscule 1.33% of the entire public float. And when you factor in Nvidia's enormous daily trading volume, the days to cover ratio is a tiny 2.0. In plain English, there is absolutely no structural setup for a short squeeze here whatsoever. Any real upward momentum from this point forward will have to come strictly and purely from fundamental institutional buying. Which forces us right back to confronting the single most terrifying fundamental risk for anyone who invests in hardware companies. And we have to face it head on. Hardware markets are historically incredibly volatile. Capital expenditure binges in the tech world very often end in painful, devastating busts. Just think back to the telecom crash of the early 2000s, or even go all the way back to the auto boom of the 1920s. If the hyperscalers suddenly decide to pull back on their projected $1 trillion in capital expenditure for 2026, 2027, then that low, attractive forward PE of 18 becomes a complete illusion because the underlying earnings will simply collapse. However, the current order backlogs, the emerging wave of sovereign AI initiatives from entire nations, and the expansion into enterprise and industrial markets all strongly suggest that the spending floor is actually far more stable than the fearmongers want you to believe. So this leaves us with one final crucial question. If the downside really is well protected, and if that competitive moat truly is intact, then what should our realistic expectations actually be moving forward from here? Let's be honest and clear-eyed about this. The days of 1,000% parabolic surges are in all likelihood firmly behind us. But here's the thing, that is actually a deeply healthy evolution for a company of this size and importance. What we should now reasonably expect is an entirely new era of steady, fundamental compounding. Think about it this way. If Nvidia simply continues to trade in line with the S&P 500's average multiple while its earnings keep growing the way they have been, then the stock has a very realistic path toward the $300 to $345 range over the medium term. And that, my friends, represents a highly attractive 50 to 70% upside from where the stock sits today. Not through hype, not through mania, but through pure, boring, relentless fundamentals. And all of this brings us at last to the final verdict on what really is the underpriced architecture of the entire AI era. Before I give you my honest take, a quick and important note. I am not a financial advisor, and absolutely nothing in this video should be taken as personalized financial or investment advice. This is for educational and informational purposes only. Investing always carries real risk, so please always do your own thorough research and consider speaking with a qualified professional before making any decisions with your money. With that said, here is the honest conclusion. The market has become so completely accustomed to Nvidia delivering spectacular, record-shattering earnings beats that genuinely exceptional, record-breaking performance is now somehow viewed as a baseline failure. And yes, I'll be transparent with you. My own biggest personal doubt still remains the sheer concentration of revenue among just a small handful of tech giants. If even one of them meaningfully cuts their spending, the psychological damage to the stock could be severe in the short term. But when you finally step back from all the noise, all the headlines and all the fear, what do you actually see? You see an unbroken competitive moat, a historic valuation anomaly, and the smartest money in the world quietly buying up shares. When you look purely at the cold, hard numbers, the risk-to-reward ratio here skews heavily in favor of the patient contrarian. So now I genuinely want to hear from you. If Nvidia is truly this cheap and this dominant, and why do you personally think the market is still so afraid of it? Are the bears seeing something the data isn't showing us? Or is this simply the greatest fear-driven mispricing of our generation? Drop your honest take in the comments below. I read every single one, and I would love to hear your perspective. And if this breakdown gave you a fresh way of looking at this stock, please smash that like button and subscribe so you never miss the next deep dive. Until next time.